I love investing, but it's not the only tactic I use to build wealth. In my latest video, I shared my investment strategy for 2026. However, there's another less obvious move that I've been taking behind the scenes, which is to do with my mortgage. And in this video, I'll be revealing why we have decided to overpay, what our mortgage repayment strategy actually is, and why I think investors should also be overpaying on their mortgage. Housing is most people's biggest expense in the UK, and buying a home is probably the biggest purchase you're ever going to make or have made in your entire life. As of today, the average home will cost just shy of £300,000, literally 7.5 times the median annual full-time salary before tax. It makes other things in our lives, even luxurious things, seem cheap by comparison. To fully drive that home, pun intended, let's take the cost of a 300k property plus the average cost of moving. This includes things like stamp duty, mortgage fees, and estate agency fees. And then divide that by the median full-time after-tax income. The result here is 9.76. What that means is that it would take a decade of saving every single penny of that median income in order to save up to buy that average house with cash. Obviously, that's impossible to do, as you've still got to live, and explains why, for anyone who doesn't have a house paid off, that more than 40% of the household budget is spent on housing, be it rent or mortgage payments. Yikes. This leads me to my main reason for trying to get mortgage free, and that is the huge drain paying rent or a mortgage has on your finances. Mr Money Mustache says that cutting your spending is much more powerful than increasing your income. The reason is that every permanent drop in your spending has a double impact. One, it increases the amount of money you can use to save up each month. And two, it also permanently reduces the amount you'll need every month for the rest of your life. So if you have any aspirations at all to retire early or to be free to choose what to do with your time, you really should be prioritizing reducing your spending. But even more specifically, I would say that you should be prioritizing getting mortgage free as soon as possible, because that's the biggest 40% chunk of your spending right there. And before you're tempted to leave a comment below about how you're making way more in the stock market than your mortgage is costing you, I'd like to point out that there's more to it than the gain you think you're making in the stock market, because, well, we were in that position last year. As you know, we love investing, and yet we've still updated our stance in 2026 so that we can increase our mortgage overpayments. So what are the main reasons for us increasing our overpayments this year? Our costs went up, which meant that progress on paying down that mortgage slowed down. We also value flexibility, and we want to be able to live where we want and when we want. And if you're stuck in negative equity, or you have all of your money tied up in the stock market, then you are somewhat tied to the situation and the current status of events. But with a good hefty amount of equity behind you, you've got a big hefty deposit to take where you see fit. Also, we believe it'll get us to financial independence faster, which is a huge priority of ours. Just so that you know, I also do have a website that has the option to book a call if you want to talk to me directly about your finances or investment plans. This was our mortgage last year. I've rounded the numbers a bit, but you get the idea. The big factors are that we owed around 100k on a 2% interest rate over 35 years. We had just hit this big milestone of getting the mortgage below 6 figures after aggressively overpaying for 5 years. And so we were honestly coasting a bit, paying just £500 per month after I quit my 9 to 5 to start my business. Then our mortgage came up for renewal and the interest rate doubled. We went from £333 going towards repayment every single month to everything but £167 of that £500 servicing debt. And while we'd been happy to temporarily pay a little bit less towards the mortgage, we didn't want progress to slow down by that much. So by upping our payments to £800, we're now steadily building £467 worth of equity per month and shaving 13 years and 8 months off the time it will take to own our home in full. This is where mortgage overpayments prove their worth, because you're about to see how much equity we've built in just 5 years. Now bear in mind we were being previously much more aggressive on this, but after just 5 short years, we already own £130,000 of our home. And contrary to what some people would say, that money isn't just sitting there. It's actually saving us 4%, which is equivalent to £5,200 every single year, compared to if we owed that much more on the mortgage. This is a great starter point, but there's actually a much bigger impact this is having on our lives, which means that overpaying is even more valuable than you'd ever had expected. And this is why I think also in particular, investors should be considering also overpaying on their mortgage. By overpaying, you reduce your expenses, meaning that you not only save on interest, but also have more money to put towards other assets, such as investing. Taking this a step further, let's say you use the money that you save from having to pay less in interest and you put it towards your workplace pension. For a basic rate taxpayer on a salary sacrifice scheme, every £1 you put in could save you paying 28 pence in taxes. And for a higher rate taxpayer, the value is as high as 42 pence. That is purely your money working harder for you rather than being lost to the tax man. Because if you took it as income, you would need to pay the tax. Whereas by investing it through your workplace pension, you're about to see the massive effect this can have on your wealth. For example, the £5,200 that we saved on mortgage interest becomes £6,656 or £7,384 if you are a higher rate taxpayer. Those numbers can 10x over the next 30 years, assuming an 8% annual return on investment. And yes, this is based on historical performance, so it's not a done deal. And yet, it's also based on just 1 year's worth of savings being put towards investments instead of mortgage interest. And that wouldn't have happened if you hadn't overpaid on your mortgage to begin with. And then the end result of this? Well, by overpaying your mortgage, you actually end up with more invested into the stock market, letting you keep more of your hard-earned money and live more efficiently and with less fixed expenses. That in turn reduces the timeline to your financial freedom and living your best wealthy life. If you want to chat about any of this, remember to book in a free call via my website. The link is in the description. Hope you enjoyed this video. Thanks for watching, and I'll see you in the next one.